Worldwide banking system on the verge of collapse. According to many economists, the banking system has never been in a more vicarious position as the world economy continues to decline and is on the verge of total collapse. Those that are responsible for this calamity and impending crisis are none other than Jerome Powell and the Federal Reserve. If the Federal Reserve continues on its current trajectory of raising interest rates and haphazardly printing trillions of dollars, this will absolutely cripple the economy, forcing the United States into a severe and prolonged crisis. Now the question remains, is this a calculated and controlled implosion? Everything from their movements, to the words that come out of their mouths, to the choices that they ultimately make leads one to wonder if everything is predetermined. The worst part is that they are forcing the economy off a cliff with little chance of recovery. Hello, and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we start, make sure to leave a like, subscribe, and comment below if you enjoyed watching this video, and turn on the notification bell to keep posted. And now, without further ado, let's start. Many years have passed since the first signs of this impending catastrophe appeared. The emergence of COVID, the implementation of lockdowns, and the injection of trillions of dollars into the economy despite assurances that this would not cause inflation. But then came inflation, which was an issue that no one wanted to deal with. That's why nobody paid any attention to it. Eventually, it reached a point where it could no longer be disregarded despite the Fed's best efforts to argue that it was beneficial for us, and they began to tighten monetary conditions. However, it was already too late. Inflation remained substantially higher than anticipated, and interest rates went from 0% to 5% in the most rapid rate hiking process in history. This was the point at which issues began to surface. Additionally, unemployment remained dangerously low despite the Federal Reserve raising rates by 5% and draining the market of $600 billion worth of liquidity. Moreover, inflation will stay high until the Fed finds a way to break the employment market, which implies the Fed is not done raising interest rates just yet. Throughout this period, people have been closely monitoring the number of jobs around the nation. Markets react positively to any decline and fearfully to any increase because they know that inflation is not done until job figures start to decrease. This was already awful news, given that the Fed's proclaimed goal of breaking the job market will lead to the loss of jobs, companies, homes, and lives for many people and trigger a recession. But behind the scenes, the bond market was gradually becoming more severe. The Federal Reserve's efforts to tighten the market caused bond rates to increase, and not just a little. When the first lockdowns began, the yield on the 10-year U.S. Treasury bond was 0.7%, but by the end of 2022, it had risen to nearly 4%. This indicates that the value of these bonds has plummeted. TLT, an ETF that aims to track the prices rather than yields of U.S. government bonds, has seen a decline in value of about 40% within the same time frame. This implies that should the bond owner ever need to sell the bonds before maturity, they would incur enormous losses, which would cause the banks to fail. This was the case with Silicon Valley Bank, and the single factor that led to the institution's failure. They were forced to sell some of these bonds, resulting in a $1.8 billion loss. The Federal Reserve has been tightening market conditions, which has decreased the value of these bonds. They cannot cease tightening market conditions unless they want the United States to experience inflation similar to that in the 1980s. Millions of investors have been keeping a close eye on the markets, watching the Fed raise interest rates, and waiting for the employment market to turn as a sign that the Fed has successfully halted inflation. However, each of those investors had been looking in the wrong place. Banks failed before inflation and the employment market, and everything changed abruptly. Without the government bailouts, many more financial institutions would have failed. Now that the Federal Reserve is again in such a dark place about its course forward, this implies that there will be even more volatility in the markets, and it is probable that there will be other bank failures. Even Ken Griffin recently claimed that American capitalism was imploding right in front of our eyes, and JP Morgan predicts that the S&P 500 will drop another 20% as the economy stands on the verge of collapse. Unsurprisingly, over 90% of financial advisors plan to invest heavily in alternative assets during the next 2 years to decrease volatility. However, Larry Fink of BlackRock and the head of investing at Bank of America have suggested one high-performing alternative to help you save your money: fine arts. The average price of an artwork increased by 29% last year, and Masterworks gave its investors a return of nearly $25 million. Now, many are attempting to figure out if the Federal Reserve's pivot or their decision to cease tightening conditions and start loosening them is coming soon or has already occurred. Despite not raising interest rates in March, the Fed's balance sheet reveals that they have already begun moving in the other direction. The Federal Reserve raised the size of the balance sheet by more than $300 billion during this crisis, and they did it in a couple of days. This indicates that the Fed has just undone nearly 6 months of work to combat inflation. They produced $300 billion out of thin air, influencing future inflation rates. To some extent, the Federal Reserve's actions here may be interpreted as a pivot, as one possible interpretation of a pivot would be for the Fed to start printing money in response to the financial crisis, resulting in higher inflation. Similar to how investors previously monitored the labor market for signs of a turnaround, everyone is now watching interest rates for signs of a decline. This isn't precisely a pivot from the Federal Reserve, but it reveals the institution's true nature, goals, and course of action if things start to go really bad. They were ready to generate an additional $300 billion out of thin air to save multi-billion-dollar tech corporations and the wealthy founders of those companies. This is not a pivot yet, but it offers evidence for the assumption that the pivot will arrive early, resulting in a decade of high inflation and a sluggish economy. Without a doubt, the Fed will keep raising interest rates for the time being, which will further weaken the banking sector. If this happens, the Fed will play the hero and print trillions of dollars to prevent a global depression, thus driving us into constant massive inflation. The Federal Reserve is driving the economy in a direction that can only end in disaster, but they are unable to halt the train wreck they are creating. Interest rates will continue to rise, which will have a negative effect on bond prices. This implies that banks, which own hundreds of billions of dollars worth of bonds, will continue to lose money and rack up increasing amounts of paper losses. Let's remember that the realized losses at Silicon Valley Bank only amounted to $1.8 billion. That was all it needed to bring the bank to its knees. Financial institutions that follow the lead of Silicon Valley Bank and place risky bets on the future direction of interest rates will be the first to collapse. But all financial institutions will feel the effects of this. Banks are forced to invest in costly hedges to protect themselves against failure when faced with such a large amount of paper losses. Following the recent wave of bank failures in the United States, which has begun to ripple throughout Europe, it is no surprise that banks are scrambling to stock up on hedges in an effort to protect their assets. However, this implies that they will generate less money in the future. Their revenues will decline, their expenses will grow, and their stock prices will reflect this new reality in addition to the enormous losses they suffered during this crisis. This will have a trickle-down effect across the economy, which will multiply as it travels through the system. Within a week of the crisis, Goldman Sachs dropped its GDP predictions for the United States for 2023, and they are going closer and closer to projecting an actual recession, and other institutions are doing the same. According to several banking institutions, the collapse of SVB is estimated to have cost the American economy several $100 billion. Hi! We hope that watching this video was interesting and that you learned something valuable. If you enjoyed it, please hit the notification button, like, subscribe, and watch more of our videos. Also, don't forget to share your comments in the comment section below. This is Finance Sense, helping you stay current on all the most recent changes in the financial markets and economy. Stay safe and look out for the next video.